Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. Good to see you today.
Nice to see you as well. So I've come to realize even if Q2 GDP is negative, that the 10 economists that will declare a recession will not declare Q1 and Q2 a recession because of strong growth, retail sales, and so forth. So that said, I do believe a recession is in the offing, and I think it's closer than most people expect. I actually now believe it's Q3, Q4. And more importantly, Greg, and this is what I want to talk to you about, I actually think the housing market is going to be the reason we have a recession in Q3, Q4. I see such a crash in transactions and overall activity, mortgage, refi, construction, all of these things. I think housing is going to cause the Q3, Q4 recession. How's that feel?
It'll be interesting. And the other reason economists don't want to label, recession right now too, is because the employment picture, right? Because there's so many available jobs, so few people taking them. So the employment market is healthy from that standpoint. And then, yeah, technically we're in a recession. We have been, but it's very minor. So when you say housing can cause a recession, what level do you mean? Because recession is defined by negative GDP 2 quarters in a row. We've already got that. So
yeah. So there's actually subsequent data, right? So I have an econ degree, and that rule of thumb is just that, right? 2 quarters of negative GDP is a recession. It's worked every year since 1947. It didn't work in 1947, and I don't think it's going to work in 2022 because, again, the last 6 months we created 2.4 million jobs. The lowest month was 370,000. Unemployment was never above 3.6%. No chance Q1 and Q2 are called a recession. Negative GDP, sure, but not a recession. I believe it'll be Q3, Q4, because what I think is going to happen is the transactions in real estate and just the liquidity being sucked from the market is going to cause the velocity of money to fall. Negative wealth effect is going to fall, and housing. The housing bucket in GDP is roughly 15%. I think we lose 4% of GDP just because the housing market is not moving. And I think that'll be real recession.
And real recession is job loss, businesses closing, things like that.
Retail sales falling, industrial production, all of those things.
Yeah, at a sustained and substantial level. So, the housing market's interesting. And, obviously there's pockets, here and there that are doing different things. My market is still red hot because there's no inventory, in certain areas. In certain little pockets, like even where I came from in the Outer Banks, if you look at that market, there's certain little areas on the Outer Banks that have no inventory and stuff is still moving. Wow. It's stupid numbers. Yeah. And same thing in my market here. And then there's other areas there where inventory is like tenfold what it was. I mean, it's just increasing big time. So it's really interesting. And, it's such a different environment now. You already can't produce. I think what happens is, I don't know that would cause a recession. I think it would just create health in the market because the construction market is so stressed right now, from a labor standpoint that, if people stop building, well, it's just going to move into other areas of home improvement, all these other things that people stay in their homes because they have great mortgages and, that type of thing. And it doesn't make sense for them to sell with prices where they, I don't know if the housing market is in a big enough issue where that will cause a problem just because transactions, change or crash or whatever, because once prices adjust, then they'll pick right back up again. It's all relevant.
But you and I've talked about this a bunch. Again, it's really weird, right? Because recessions are calendar based every 90 days, right? It's quarterly based. And I think transactions crash Q3, Q4, like we haven't seen before. I do not see prices adjusting that fast. Any price adjustments.
You're seeing, like you said, less money going in realtors' pockets, everybody who's involved in the transaction, realtors, title companies, attorneys, inspectors, all of those things are changing. Mortgage, companies that are, closing up shop, laying people off. So there's contagion in the space right now. The question is it a big enough percentage in the space anytime soon to really have that big of an impact? I don't know. I mean, we'd have to look at some of the bigger markets and see what's happening right now. And you're already starting to see it happen in, Arizona, Nevada, the Carolinas, Florida, some markets of Florida, some other markets are red hot. So
yeah, no, it's going to be interesting.
It's possible, but you need a huge dent, for that to happen.
Yeah, I'm calling 30% this year, maybe a little bit more. We already saw. I mean, I interview a Las Vegas broker, and in a month, 26% transactions down in 1 month.
Yeah.
That is bananas. That's crazy.
Yeah.
That's
And for
that's
anybody watching,
extreme.
you can go to the National Association of Realtors website and you can get that information. You can get, transactions and kind of track it for different markets. And yeah, it'll be interesting. And, they're obviously down everywhere, and if rates go higher, which, the bond market's been kind of maintaining, which is interesting. But, if rates go higher into the sixes, I talked to somebody about it the other day, sixes close to 7, I think you'll see it just completely fall off a cliff then.
Yeah, I think, and again, I think this is all game. I think when the Federal Reserve, specifically Powell, answered that last question at his last Fed meeting about housing reset, I think he's basically said, I'm going to break it. I'm going to cause transactions to stop. I'm going to raise rates so 18 million people are no longer qualify. I'm going to get more listings on, and we're going to get to we're going to get to 2 million inventory. We're sitting at 1.2 or whatever it is today. It's I think it is. And again, I'm making an early call. I like to do this. If I'm right, I look great. If I don't, I look like a fool. I'm okay with that. But yeah, I think the Q3, Q4 recession is housing based. The other thing that we'll put it on record, is refi. Cash out refis are down 80%. That's real money that people used to spend on vacations or improvements or whatever. That's just not there anymore.
Yeah. They used to see boats in every driveway that came out of the refi market. But yeah, I mean, it's huge. I mean, that's a big segment of it as well. The refi market pumping money in the economy. And yeah, all those things make a big difference. And then you have the student loan debt bubble, that's about to pop. That's becoming a big problem. We just talked about the auto loan market that can, there's a credit crack getting ready to happen there. So, when you add all these things up, I mean, there's, some serious contagion out there, where we are right now, but it needs to happen,
I agree.
To reset things and bring things back down to a healthy level so we can do it all over again.
Yeah, exactly. Got to build a base so we can grow from there. Yeah, exactly. Yeah. And again, the last thing we haven't talked about in a while, but really what I'm pointing at here is, again, video 1, we talked about the market and all of that. Housing slowing down is the negative wealth effect. It is a real thing. When people feel flush or rich or wealthy, whatever the word you use, they spend more. And when you are scared and looking at your 401k or trading account or your house going down, you don't feel as rich, and you don't spend as freely. And I think we're about to go through at least 6 months of a negative wealth effect that's just grinding. What do you think?
Yeah, which is intentional. That's why they're raising rates. That's why they're, affecting housing and asset prices and all that, is they want people to feel less wealthy. So you spend less money. So the economy slows down. And the soft landing is they're trying to do this without putting the country into a real recession and try to land it, excuse me, as soft as possible. The other thing that's funny too, is you'll see people, say, out there in comments on Twitter, if this recession is so predicted and everybody knows it's coming, doesn't that mean it's not going to be as bad, or it's not going to happen, or, kind of like the whole market thing. If everybody thinks it's going up, it's not going, no, everybody knows recession is coming. It is predictable. It's not a black swan, like, other things that happened like 2009, the pandemic, all that, just because everybody knows it's coming and it's predicted doesn't change the outcome. It just helps you prepare. And that's, what the Fed wanted to do, and that's the intention. It's not going to stop it just because it's coming. It's not going to be any worse or any better just because it's coming. The question is, how deep does it go? Because all of the other, like you're talking about, the housing market and all these other butterfly effects throughout the economy, that these I mean, real estate's a huge asset class.
It is.
It's not just housing. The commercial market bubble has popped. Rents are behind and dropping. So everybody thought rents would go up forever. What I always say, rents can only rise to a certain point. They can't go up exponentially forever because it's income based. We're seeing rents back up and decline in a lot of the major markets around the country right now. We're seeing vacancies, and we're seeing, vacant homes start to pile up as well. So, this is how it starts. Question is, can they control it and contain it, or does it,
what? We will make that video number 3, because one of the topics I wrote down is I see a lot of kind of guru syndicators who have great names because of this or that, trying to do raises on big buildings right now. And I'm like, this is such bad timing. Because I think regression to the mean gets them both on cap rate, on rent, on vacancies, collections. It's not a good time to be getting into a high priced asset like that. So we'll make that video 3. Greg, where can people find you?
Yeah, gregdickerson.com.
Awesome. Thanks, buddy.